Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Corey. Corey, thank you for joining me back on Upticks.
Jake, thank you for having me.
And a special thank you to all of our subscribers, followers, people tuning in. Our subscriber count, Corey, is growing very quickly. And special shout out here to Luke, our content manager. Luke, you're doing some great work getting our content in front of more people. So thank you. If you haven't already subscribed, what are you waiting on? And if you have subscribed or you like this episode, let's get a thumbs up or a 5-star rating.
5.
That's how more people get to see our content. So thank you all. And again, our mission with Upticks here is we're really just looking to enhance financial literacy. Please don't take anything that we say as advice. If you want some advice, I'll give it to you. You just got to schedule with me. Best way to get on my schedule is service@falconwealthadvisors.com. Send an email to our service group and you can get on my schedule or Corey's, and we can give you some real financial advice. Corey, anything before I kick us off here?
Kick us off.
All right. So thank you for a listener for sending in an article. So again, if you read or watch or hear something and you want us to talk about it live on Upticks here, simply email that into our service group email, service@falconwealthadvisors.com, or directly to Luke, which is luke@falconwealthadvisors.com, and he will make sure we talk about your article on air. So we'll kick it off first here. This article was in the Kansas City Star, and the title of the article, Corey, is "What is the goal of the 60-40 portfolio?" And I'll quote the individual that sent this in. He said, an article in the Kansas City Star, this was Wednesday, November 15th, by Allison Schrager, is a Bloomberg opinion titled, "What is the goal of the 60-40 portfolio?" It caught my eye as it is close to what my portfolio with Falcon Wealth is. Corey, what are your thoughts here?
The article posed a great point that you do need to be clear on what the goals and what the intentions are for the strategy itself. And I think, Jake, you and I probably both agree that, blanket cookie cutter approaches is not the right advice that should be blanketed out there for anyone, which they really talked some about in this article. But, from my point of view, it really comes down to each individual client, each individual financial plan, and each individual person's spending and cash flow, because that's really the piece that should derive how a portfolio is invested for somebody who's at or near retirement.
Yeah, and did you read my notes before you just started talking?
No, I didn't.
Okay, because I've got my notes here from the article. And again, thank you for our listener for sending this in.
Yes.
The article says, though, that the 64 portfolio is a cookie cutter approach to investing, and that is not okay. And so to give a little bit of backstory, historically speaking, I think it goes back to Harry Markowitz, who is the inventor of modern portfolio theory, which we actually believe a lot of what modern portfolio theory says, and that's a whole nother topic for another show. But the argument in the article, Corey, is that he invented this, even though the article says you can't find any proof of that. But basically
Right.
What it's saying is 60% in stocks, 40% in bonds is the optimum blend for a proper risk return adjustment or a reward, basically. So you're taking a good amount of risk, you've got a good amount in safe, and that should give you a good risk adjusted return. I think it is way too cookie cutter, like you said. Also, 60-40 can mean very different things. Is it 60% in US stocks? Is it large caps? Is it small caps? Is it international? What type of stocks? There's a lot of different types of stocks. And then 40%, is it in treasury bonds, corporate bonds, junk bonds? So there's a lot of different things that 60-40 can actually mean. So let me talk, though, Corey, about how we come up with our allocation for our clients. And so yes, some of our clients may be in what's called 60-40. They may have 60% in stocks and may have 40% in bonds. But ultimately, Corey, and you know this, we come up with our allocation based on how many years of income is required for an individual in retirement. So let's say you need $50,000 a year from your investment account. We want to have a minimum of $250,000 in bonds, right? So what we do is 5 years or 250,000 in this scenario, ideally 10 years, but a minimum 5. And so that actually will determine the allocation. So if somebody has, $1 million, then theoretically, Corey, they could be 75 in stocks and 25 in bonds.
Right.
And that would weather the storm. And the reason we pick 5 years is that's the typical economic cycle from peak to trough. Again, 10 years is even better, in my opinion, but 5 is sufficient in our experience. The worst market cycle, Corey, that I've been through as an advisor is 2007, 2008. This process worked really well during that. That was probably about a 3-year issue where we went down 56% in the stock market, and it took 2 or 3 years to get back up. You've had some volatile years in your career as well. I don't think you've had any that long, have you? That's taken 3 years to recover. Probably not.
2014 through 2016 was just a sideways choppy market, but that would be probably the closest thing from just simply a prolonged period of time.
Yeah, that does make sense. So again, our allocation does not come from some cookie cutter approach. The takeaway here is we want to know how much money you need, and that determines how much you have in bonds, and that determines the allocation. So great article. Thank you for sharing. And good for the Kansas City Star to actually put something in from Bloomberg. I thought that was cool.
Right. Yeah, I saw that was distributed from whatever the the content group is that published it. So it was good to see it, because I think the author did make a lot of good points that it's not as simple as just saying 60 here, 40 here, and off you go.
Right.
Very good. Next on the docket here, Jake, this is an article from the Wall Street Journal that you uploaded here. The inflation causes IRS to raise tax brackets and the standard deduction by 5.4%. Tell me what you think about that.
I told you inflation was a good thing, Corey, and I'm going to keep rubbing it in, right? So here's where we go. Here's an upside to persistent inflation. This is from the article. More of your income will be taxed at lower rates next year. That's a good thing, Corey. The standard deduction and the thresholds for each tax bracket are up 5.4%. That's the second largest adjustment in the last 3 decades, Corey, 30 years after last year's 7.1% hike. So let me give you a little bit of context here. So the threshold for the top federal income tax bracket in 2024 will climb by nearly $40,000. And that's next year for a married couple. So the 37% income tax rate will apply to income above $731,200. And for individuals, that top tax bracket will start at $609,350. So basically, your effective tax rate will be lower than your top rate. And that is because the first slice of your income is taxed at 10%, and the next it's 12%, and so on. Your effective tax rate is essentially a blended rate. A lot of people don't know that. Most people in their heads, Corey, this is from the article also, say that I'm in the 24% bracket and that's my tax rate. But when you're in the 24% bracket, you're not paying 24% on all of your income. It's graduated. I also want to point out one other thing, and I want to hear what you think. In 2024, the contribution limit for 401ks and other workplace plans are $23,000. That's up $500 from this year. And it's up another $7,500 if you're 50 and older. So the contribution limit for individual retirement accounts or IRAs is $7,000, up from $6,500. Corey, can't say it enough. Inflation is good.
I know that's your opinion, Jake, and I understand that it allows people to save more money. Where our disagreement, I think, lies as it pertains to inflation is not adjustments to tax brackets or standard deductions or anything else. It ultimately has to do with the purchasing power of a dollar. And my perspective,
I know. And this isn't about inflation. I was rubbing it in a little.
All right. Well, hey, I didn't go there.
I'm just saying you're right. Purchasing power is weaker potentially, but maybe you're getting some of it back in the form of lower taxes or lower effective taxes. I had to rub it in a little bit.
All right.
All right, Corey. So here's one. Stages of retirement. It's not just about your savings.
This is good because this is it's a little softer here talking about the retirement piece, but it's important because it is focusing on what goes into retirement that's not just money. And I liked the way the article really, in the author, laid this out, because really the point here was that going from a set schedule to retirement where you can really do as you please can come as a shock to a lot of people. And the honeymoon retirement phase that can exist for people for a period of time after they retire eventually fades. And, people can lose their sense of purpose, and people struggle transitioning from working and saving to spending in leisure, whatever that may look like in retirement. They also pointed out in this article that if you're married, that it's really important, which we talked about. It was actually somewhere else, Jake, on this show, I know, within the last few months that we highlighted this point, is that if you and your spouse need to be clear on what your goals for retirement are, because they might not be the same, or they might look very different, but it's good to have some clarity around that. And ultimately, the point here was that the plan for retirement, the first phase of retirement planning happens long before you get to retirement. And it happens with the planning piece to work through these conversations and the finances to make sure that you're ready to go when the time comes.
Yeah, that's good, Corey. You're right. I think we do a good job at Falcon Wealth Advisors is having some of these softer conversations with our clients. And again, ultimately, if a client needs even more help, we actually can enlist a retirement coach and refer that out, because, we deal in dollars and cents every day, but it's also important that you understand your purpose, because the last thing I want, Corey, is somebody with $8 million, but they're very depressed, right? I don't want that, right? And so it's both. You've got to have the money planned out, and you've got to have the purpose planned out. And I think that's important. And I'm glad you brought it up, because it's not something that I think a lot of advisors understand. I think they get caught up in the dollars and cents, and I think it's important. And the only way we're able to do that, Corey, is because we have a team around us. We've got a ton of financial planners. Now we're coming up on 6. We'll have 6 financial planners here very soon. And we do that on purpose so that we have time to have these types of conversations with our clients. So you and I are meeting with clients, our financial planners are meeting with clients. And if we didn't surround ourselves with other trained professionals that can have these softer conversations, it would probably be virtually impossible for us to have the time to do that. So it's good to have a team around us that we can have these conversations with our clients.
And it's good for people who are struggling with this to know that they can talk to someone about it. I think, Jake, from my point of view, which is anecdotally, we've met with enough people, hundreds, if not thousands of people over the years, that it doesn't mean that either of us have seen everything, but it does mean that we've seen some of the issues, concerns, struggles, maybe that other people have gone through, that we can take some advice away to give to someone else. And that's ultimately a good thing for everyone.
Yeah.
All right. The next one here is the 4% rule is back. It's from the Wall Street Journal. What is the 4% rule, Jake?
The 4% rule for retirement is back, Corey. You missed a word on the document.
I got too excited reading the 4% rule is back. The 4% rule for retirement is back. Let's talk about that.
Yeah, and I don't agree with this. So if anyone watching or listening, we do not believe in the 4% rule at Falcon Wealth Advisors. And let me explain what it is. So it's a very paper napkin way to do financial planning for clients. And basically it says if you have $1 million, Corey, you can pull $40,000 a year and increase that every year for inflation. And quote unquote, you should be good to go the rest of your life. I don't like that, because life is dynamic, and it just doesn't make sense. For many clients, it could be too high or it could be too low. So I think it's absurd to do that. And I've got 2 big reasons, Corey. And again, number one, I think your withdrawal rate needs to be influenced by your target rate of return, or at least your average rate of return. Because of many of our clients, Corey, I'd say 90% of our clients are not looking to leave $20 million to their kiddos. And so I'm convinced that 4% for some clients, and again, it's based on your investment returns, is far too low. And they could be cheating themselves out of a enjoyable retirement, right? Because if my client is puckered up and they can't spend anything because, they'd rather spend 6%, but I'm telling them they can only spend 4%. But what if I'm making them 7%? So that's my problem. So I think that your withdrawal rate needs to be based on your financial plan. And then we need to look at your average rate of return, which we do that for every client. And that should determine how much you pull. And also my second problem with it is most of my clients, and I don't know if you differ from this, Corey, but most of my clients, even in this current environment, do not increase their withdrawals based on inflation. It just doesn't happen. Many clients actually spend more money in the early years, and then they reverse or slow down their income. They don't speed it up. And so we call that the go-go years. And their go-go years, Corey, they're actually spending more. And in their slow-go years, they're spending less. Well, this 4% rule thinks that you're going to start way down here at the bottom and then go up. I'd rather see clients spend up here and then go down if that's what they want to do. So financial planning is way more nuanced than using some paper napkin strategy. I think it's ridiculous that a financial advisor would even say this to a client. I don't know if any that do, but if they would, I think it's silly. What are your thoughts?
This feels very aligned with me. As far as the first article that we talked about goes, the 60-40 portfolio, it's just the same concept here, is that there's no blanket one size fits all for everyone. And it's clear, and that hopefully is clear to anybody who's watching or listening to the show. And if you've watched or listened to previous episodes or in the future, I would imagine, Jake, we're going to continue to bang that drum, because there is information that's put out there like this that people can ultimately take away and say, oh, this is what I need to do. I can't spend more than 4% because that's the rule. It's not a hard, fast rule for everyone.
Right. And maybe if you're doing it by yourself, I don't think you should manage your retirement by yourself, but maybe for the do-it-yourselfer, I guess I could see that. But again,
I still think the logic, though, of you're just having gradual, ever increasing expenses until the day that you die, as morbid as that is, just is not, practically speaking, is not the way to structure how you're going to spend your retirement and spend money in retirement.
Right. Many of my clients, this is my 17th year. Many of my clients have been retired for 15 years. Corey, they're not spending more money than they were 15 years ago. They're just not.
And they might be spending less.
Well, yeah, that's what I was getting at. Exactly.
Yeah.
All right, good thing that we agree there. So
that is a good thing.
It's pretty fundamental for us, at least. All right, Corey, Wall Street's ESG craze is fading. You've got a chart here. Let's hear about it.
All right. So ESG stands for environmental, social, and corporate governance investing, which is, I'm sure this is an acronym that a lot of people have heard over the last few years. And the big point here, and as displayed by this chart, is really talking about how Wall Street and asset management firms rushed to embrace sustainable investing just a few years ago. And they are now quietly closing funds or scrubbing ESG from fund names after ultimately investors have had disappointing returns. And the about face has come after tightened regulatory oversight, higher interest rates, and the impact they've had on clean energy stocks. And ultimately, there's been some backlash that ESG investing has become a political target. And the reason I think it's good for us to talk about this today is just understanding the environment that we're in, understanding what mania, for the lack of a better term, ESG has been for the last few years and where that's ended up today. I think the bottom line on this is to be careful chasing whatever's hot, because we've talked multiple times on the show, and I'm sure we still will, about how things rise and fall, and to ultimately be careful with that. But I found this really fascinating, that really what we maybe felt, some people may have felt to be true a couple of years ago, has really played out the way a lot of people expected.
Yeah, and it comes down to money, in my opinion, with this. I mean, this is the way I see it. I agree. I mean, we don't want to invest in companies that are corrupt or dirty or do bad things. But you know what's good about the free markets is many times those companies go out of business if they're doing shady stuff and it's not good. So I think you should let the free market dictate what a company is worth. And if you invest appropriately and have success and you want to save the planet or save the world, then you should go donate to charity or volunteer. And, so let's go make a lot of money in good companies that are profitable. And then let's go donate a lot of that money back to other worthy causes. In my opinion, that's the way to do ESG investing, not by doing it in the stock market. Now, Corey, I don't know if we got lucky, but we've never embraced this, believe it or not. Like, we never fully dismissed it. I always keep it on my radar, but it's not something that we at Falcon Wealth Advisors have full on adopted as, you know what, we're going to have an ESG portfolio. We're going to really do good by investing. I just feel like we just continue to keep our heads down and invest in companies that we think are good for our clients, that have predictable cash flows, earnings growth, all the standard metrics, and hopefully our clients do well, and then they could donate their money to charity versus trying to do two different things with one strategy.
Yeah, real quick, I have strong opinions on this, Jake, and my strong opinions on this are that the ESG craze was largely a way for asset managers to gather more assets, which is what I thought a couple of years ago, and it's still what I think now. And I also think that ESG investing in a company's ESG score and determining where it fits in a portfolio was very much a luxury during a peacetime era with zero interest rates. This is something that everybody cared about 5 years ago, and today hardly anybody's talking about.
Right. You're right. Sadly, it probably was just another product that was created so they could get more money.
Yes.
Crazy.
Well, and sure enough, the returns have been disappointing. And now a lot of funds are taking that acronym out of their fund name. So anyway.
Wow.
All right, Jake, should you get a lease or a car loan?
Yeah, so this is a good one, Corey. So Rachel has leased and she's buying right now in the process of making payments on a car. So I've had some experience with this in our household. And the overarching bottom line is, Corey, we've got to run the numbers because I can't just, and again, the point of this show is not to give advice, but I've got some general thoughts on leasing and I want to hear yours. There's pros and cons of both. This is a really good article. This is in the Wall Street Journal on the personal finance section. But in my opinion, Corey, it comes down to behavior. If you're the type of person, and we know who those people are out there, that are looking for a new car every few years, then I'd highly suggest you consider leasing. But if you're okay driving a car for at least 5, 10, or 20 years, then generally speaking, buying may make sense. And the reason is, Corey, cars depreciate, right? So if you are buying a new car every 3 years before you even pay it off, and typically car loans are higher than car leases. And that's what I'm getting at. So you may be able to lease a car for $400 a month, but if you're buying the car, you're paying $600 a month. So why not just lease it and know that you're always going to have a car payment? And you know what? You'll always have a brand new car or pretty new car, the latest technology. You don't have to worry about maintenance and so forth. So that's really the good favor for leasing. What I didn't like about leasing, when we turned Rachel's car back in, there's all these hidden fees. They supposedly found a scratch on the trunk, and I feel like they ding you for a lot. So I didn't like that about that process. So for me, we favor driving our cars a long time and buying them. But again, if you're the type of person that wants a new car, just likes it, and that's one of the things that you don't mind spending money on, then it may be okay. And again, ultimately comes down to your financial plan. Corey, you've leased. Are you leasing now?
I am.
Okay, so why don't you give your case for why do you keep leasing?
Yeah, so this is my third or fourth vehicle that I have leased.
No.
And yes.
No, it's not.
Yes, it is.
Really? Okay.
Yes, it is. It is the fourth, actually, now that I think about it. Now, one interesting point that you said about Rachel's car was, did you guys buy the car that she leased at the end of the lease? Okay.
No, we turned it back in. But we turned it back in, but we bought another car from the same manufacturer. So I don't know if that mattered or not, but we gave business. We just didn't turn it in and walk away. We were like, hey, we're going to turn this one in, but we want to buy a new one from you. But go ahead.
Yeah, well, and the reason that I asked that is I was wondering if that my experience has been from buying a car at the end of the lease is that they're far more, those aren't, the hidden fees, and a lot of that can go out the window if ultimately you're interested in buying the car or leasing another one. But I do think that—
Well, isn't that what you, wait, isn't that what you did? So you were leasing, and didn't you buy that for your wife? And then you leased another one. So I bet they loved you, Corey.
Oh yeah, I'm sure they did. Yeah, absolutely. I mean, my perspective on it really has been that, a lot of it comes down to one, cash flow, because I've worked with, and I have friends and know enough people that have, and my wife is actually one of these people. Her first car she got when she was 15 years old, and she drove it until she was 29. Her first car.
All right. Way to go, Cassie.
Which is great. Yeah, absolutely. So the way that she thinks about how long she's going to drive a car is much different than other people. And it doesn't mean it's wrong.
Right.
But I also think mileage, how much someone's going to drive, very much impacts and factors into this as well. So that's my view on it. But I don't think it's again, not a one size fits all. It varies from person to person and what works for you and what makes the most sense.
So one other quick note, but I have a question for you. Then I want to make one more note. So are you going to buy your car at the end of this lease?
I'm undecided.
Okay.
Let's come back to that in the summer of 2024.
Okay, fair enough. Well, that's coming up. All right. So one other point I wanted to make, now that interest rates are much higher, so that does factor into the equation a lot more than it did a couple of years ago. So you also want to shop around, whether it's at the dealership or credit union or banks, try to shop the rates if you are going to borrow money. Obviously, paying cash might be a better way to do things now. So again, you just want to meet with your wealth advisor and crunch the numbers. And, like we said, it ultimately comes down to cash flow and your financial plan in there. But don't fool yourself. If you're getting a new car every few years, leasing might be the way to go. And that's okay. Again, that's okay because you don't have to worry about your car. And you can think of it as an electric bill, an expensive one, but it's just
Sure.
it's a bill that you're going to pay every month for reliable new transportation. And there's nothing wrong with that as long as your financial plan can support it.
Exactly.
All right, Corey, here is our last one. And then I want to end today's show with a call to action. So based on today's conversation, I'm springing this on you, but based on today's conversation, I want to bring a call to action for our listeners. But first, Corey, these stocks are trailing the market by the widest margin in 25 years. You got another chart. Let's hear it.
All right. This is going to tie us back to the 60-40 that we started the show with, Jake.
Look at
We
you.
talked about, well, what is that 60% composed of? That's exactly why this is important. This article is highlighting small cap companies, so much smaller companies, that the discrepancy in market and performance year to date has been incredibly wide, as you highlighted when you really read the article off here. But the S&P 600, which is small caps, is up 0.1% as of the publishing of this article, and the S&P 500 is up 17% in the same time frame. And that's really what this chart is displaying each and every year, basically large cap stocks versus small caps. And the thesis here, of course, is that, well, I should say, of course, the thesis is that because interest rates have moved much higher, smaller companies like this often tend to rely upon floating rate debt more than big companies may. So they feel the impact of interest rates that much more. But what's interesting is that historically speaking, after this has occurred, Jake, small caps are very cheap. So, I think the takeaway from all of this is that when you think about how you're invested in the market, there's far more than just the market, right? There's domestic, there's large caps, there's small caps, there's mid caps. And just because small cap stocks have underperformed large cap stocks in 2023 does not mean that no one should own small cap stocks.
Good. I like that. It's a big case for diversification and for our clients to know that we've got large cap, mid cap, small cap stocks. We've got dividend stocks and growth stocks. And so we don't try to predict the future. And I don't think you're trying to do that here, which is good for you. So we don't use charts to try to predict the future. We don't use anything to try to predict the future because you can't. So, but good point, Corey. Stay diversified. So this is our new takeaway, new segment here, Corey. As we wrap up today's show, my call to action for our viewers out there and listeners: let's do some tax planning. We are coming up very quickly to the end of the year, and if you have not made an appointment with our financial planners, I highly encourage you to do that so that we can take a look at your tax situation for this year. We're not CPAs. We're not going to file your taxes, but we can do tax planning. Let's take a look at everything. Maybe there's some things that we can do to lower your taxes this year to help with your long-term lifetime tax situation. So that's my call to action. Schedule an appointment with one of our financial planners and let them take a look at your tax planning situation. Corey, you got one?
My call to action would be to let us know if you think inflation is good or bad and what the impact of that ultimately is.
I already told you it's good.
I'm curious what the audience thinks.
So, what's bad is hyperinflation, Corey. Inflation is good. So yeah, I'd love to hear that. You can email Luke, email the service group. We love to hear, do you like inflation as much as Jake, or do you hate it as much as Corey? Thank you. Thank you again for tuning in, and we hope all of you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.